Hi, good afternoon. I'm here with Dave Pope at S&P Capital IQ this afternoon to discuss the latest research paper, Generating Alpha with Cross-Asset Signals. Dave, could you just describe briefly the essence of the paper that you've put together?
We're very intrigued by a class of signals that we call event-driven signals. And these, by their nature, tend to be idiosyncratic and thereby complementary to many investment strategies that investors commonly employ. In addition to that, when we have polled our clients, we see that very few investors are actually using these strategies, so it's an often overlooked class of investment strategies. The two classes, or the two signals within event-driven signals that we focus on in the paper, are changes in credit analyst ratings, as well as changes in the CDS spread.
Why is it intriguing to look at these event signals within the context of trading equities?
I think it's a matter of different perspectives. So a fixed income investor is primarily concerned with the return of principal and receipt of interest, whereas equity investors tend to be preoccupied with earnings because they're residual stakeholders. When we have times of trouble, often we can identify times of stress in the top line, making the fixed income view more timely.
Part of the research paper, central to the research paper, is looking then at the credit worthiness of companies, and I just wonder if you could maybe expand and explain the relationship between equities and credit, the credit component.
Well, we focus on three classes of credit analyst opinions: their long-term ratings, their credit outlook, as well as the credit watch. And the strongest of the signals was the changes in the long-term rating, particularly when that was a downgrade. In terms of the CDS, we focused on large changes in the CDS spread and found that 50 basis point widenings were particularly noteworthy. In addition to that, it was really the second 50 basis point widening, if it occurred, that equity investors needed to try to avoid.
Okay, very good. Thank you very much, Dave. Well, thank you for listening this afternoon, and that's all from us. Thank you very much.